Hey, what's up? Welcome to Degen Ed. That's degenerative education, meaning none of this is financial advice. Just me having fun looking at charts like the chart behind me, which is of ChargePoint, ticker symbol CHPT. And so here we are looking at it on the 1 minute time frame just after the market has closed. Current time is around 4:19 Eastern. The earnings call is about to start in around 11 minutes. I got that all set up in the web browser, so we will get connected to that in just a minute. And yeah, it does look like its prices pulled back about 2.3% in the after hours, going from a close of 173 down to around 169. But, I don't see that the earnings report has been released. There would be some news down here or something in the tab here behind me. And so what I can do, though, this is the earnings call that we will be tuning into. It's just music right now. And I am actually going to plug myself into it with my headphones so I can hear it. And then I will connect you guys once, the music stops. And yeah, so I'm just going to plug myself in here. Okay, it's just music in my ears, so no worries there. But I am going to go over to their earnings website and let's see. News, I believe, will be the tab to go to. ChargePoint reports first quarter fiscal year 2025 fiscal results. So that came out today on June 5th. So I'm going to look at that. It's a PDF here. I am actually going to include a link to this in the description of this video. So if you guys want to access it, it will be right here in the description of the video. So very easy to check that out. And let's see, yeah, I just pulled up their earnings report here, just this PDF. Usually there's like a news source or something that populates here that would say, but yeah, we could just look at this. I'm just going to zoom in so we can read it together a little bit. I'll just read it out loud to you guys. And so the first quarter fiscal of 2025 revenue of 107 million. And so the first quarter fiscal 2025 GAAP gross margin of 22% and non-GAAP gross margin of 24%. First quarter fiscal 2025 subscription revenue of 33 million represent a 27% year-over-year growth. So that's pretty good, almost a third growth. And let's see, first quarter fiscal 2025 GAAP net loss improved by 10% and non-GAAP adjusted EBITDA loss improved by 25% year over year. And so ChargePoint guides to second quarter fiscal 2025 revenue of 108 to 118 million. So that is an increase from the first quarter revenue. It's a little confusing because it's the fiscal year, and so it's 2025 rather than 2024. But they're expecting, nearly the same or, up to almost 10% increase in growth, maybe 9%, I'm not sure. And so let's see here. So let's see. Leading provider. Okay, so this is just info about them. So here's a quote. ChargePoint delivered as anticipated in the first quarter. We achieved revenue about above the midpoint of our guidance range. So I would say that they beat earnings, I believe. Sequential gross margin improvements, meaningful reduction in operating expenses, and an improvement in non-GAAP adjusted EBITDA loss. Rick Wilmer, CEO of ChargePoint, has said. So we remain focused on operational excellence, which will enable us to continue to deliver great driver experiences and be the platform of choice for everyone who wants to offer EV charging. And so let's see here, these bullet points. Revenue, first quarter revenue was 107 million, down 18% from 130 million in the prior year's same quarter. But let's see, networked charging systems revenue for the first quarter was 65.4 million, down 34% from 98.3 million. So this doesn't sound as good as it seemed above. And so the prior year's same quarter, subscription revenue was, like I said, up 27%, so 33.4 million, up from 26.4 million in the prior year's same quarters. And so, GAAP and non-GAAP. Let's see. First quarter gross margin was 22% as compared to 23% in the prior year's same quarter, and non-GAAP gross margin was 24% as compared to 25% in prior year's same quarter. We got about 6 minutes before the stream does start, or the call does start, I should say. And so operating expense, first quarter GAAP operating expenses were $90.7 million, down 18% from $110.5 million in the prior year's same quarter, with non-GAAP operating expenses that were $66.4 million, down 22% from $85.2 million in the prior year's same quarter. So let's see. Net income and loss. First quarter GAAP net loss was $71.8 million, down 10% from $79.4 million in the prior year's same quarter. Non-GAAP pre-tax net loss was $45.2 million, down 14% from $52.8 million in the prior year's same quarter. Non-GAAP adjusted EBITDA loss was $36.5 million, down 25% from $48.9 million in the prior year's same quarter. So I'll just go through this. Let's see. I'll switch over. I want to see what's going on in the chart. So yeah, I mean, it pulled back a little bit, and so ChargePoint sees revenue up 27%. So let's see. Beats. Yeah, so they beat their earnings per share. That's earnings per share. That's right. EPS. Negative 17 cents, which is a beat over 18 cents. And the estimated sales were 107 million, which is a beat over 105.791 million. And so, yeah, I mean, I think that they did pretty good. ChargePoint reports, I guess it's behind me right here. ChargePoint reports first quarter fiscal year 2025 fiscal results. Press release, ChargePoint reports first quarter. Yeah, and so this is just like kind of an initial response, and it's not too crazy. Having looked at the chart before this, I wasn't too convinced it was going to go one way or the other. So yeah, it's not too. I mean, it's down 1 cent in the after hours, so nothing too crazy. And Ben saying, "Hey, what's up?" So Blink closed at 329 at volume of. So I'll flip over to Blink real quick. I imagine that the other charging companies will probably respond pretty similarly. Let's see. Let's just look at Blink's chart for the day. Up very nicely, whereas ChargePoint, not as much. I feel like probably because of earnings, it's a little bit quiet before earnings, waiting, the calm before the storm. But yeah, I think that Blink's chart looks pretty good. It does look like it's, from just really this time frame, really just the day trading on the minute time scale. The volume average high here is right around 327.6. So this close and even in the after hours pricing right around that level. So not looking too bad there. But yeah, ChargePoint is flat after hours. So, nothing too crazy going on just yet, but we might see some volatility. And so let's see. I'm just going to finish reading these 2 bullet points. Got about 3 minutes left. And so as far as liquidity goes, as of April 30th, 2024, cash equivalents and restricted cash on the balance sheet was $292.3 million. And ChargePoint's $150 million revolving credit facility remains undrawn, and ChargePoint has no debt maturities until 2028. So any debt that they do have, they got 4 years or 3.5. And then so shares outstanding as of April 30th, the company had approximately 425 million shares of common stock outstanding. And I guess some business highlights, I'll just go over these. ChargePoint now enables access to more than 1 million places to charge worldwide across public, private, and roaming ports. And one thing that's cool, I'm not in a very big city or anything like that, a pretty small college town, and there are some ChargePoint charging stations at a local grocery store, so I find that pretty cool. And they're also connected to solar and wind, so it's, I don't know how much of their energy comes from those sources, but some of them. So I think it's a pretty cool thing to see. And following receipt of FedRAMP authorization, ChargePoint shipped its first multi-million-dollar order requiring FedRAMP certification. And then to date, ChargePoint's customers have been successful in winning more than 120 individual National Electric Vehicle Infrastructure, or NEVI, program proposed site awards totaling approximately $71 million in grant opportunities. So I think that's great. Looks like they're doing pretty good there with the business highlights. And let's consider guidance. This, I think is oftentimes what can send a stock higher or lower following earnings if the forecast is bright or, looking dim. So for the second fiscal quarter ending July 31st of 2024, ChargePoint expects revenue of 108 to 118 million. And so my understanding is last year for that time period, it was 107 million. But maybe I read that wrong. But anyways, they're guiding up. So I think that's good. For the fourth quarter of fiscal year 2025 ending January 31st of 2025, so just after, New Year's, the company reaffirms, so a month after New Year's, I should say, the company reaffirms its goal to achieve positive non-GAAP adjusted EBITDA. And ChargePoint is not able to present a reconciliation of its forward-looking non-GAAP adjusted EBITDA goal to the corresponding GAAP measure because certain potential figure adjustments, which may be significant and may include, among other items, stock-based compensation expense, are uncertain or out of its control or cannot be reasonably predicted without unreasonable effort. So the actual amount of such reconciling items could have a significant impact on ChargePoint's GAAP net loss. So conference call information on that note, it should be starting in any minute. It is now 4:30, and that is the time that the call should be starting, as you can see here. And so what I am going to do is I'm going to adjust the display so you don't see what's on my screen. You just see the chart. And then you also have the ChargePoint thing that is, let's see, I don't know if you could see my cursor, but is right behind me there. I'll probably adjust that once the call starts so it looks a little bit nicer, but that is to the call. Right now, just music, and we are at 4:31. Should be starting any minute. I am, though, going to refresh the page. It does say that it's live. Yeah, but it's just music. I have been kind of left on hold with some of these earnings calls. And actually, while we wait, and this might, cause the call to start, I'm going to try to adjust what's behind me so we can see the ChargePoint logo. It seems like it's starting.
And I'll be
I
your
will mute
conference
myself for
operator
this. I
for
hope you guys
today's
enjoy.
call. At this time, I would like to welcome everyone to the ChargePoint first quarter fiscal 2025 earnings conference call and webcast. All participants' lines have been placed in a listen-only mode to prevent any background noise. After the speaker's remarks, there'll be a question and answer session. I would now like to turn the call over to Patrick Hammer, ChargePoint's Vice President of Capital Markets and Investor Relations. Patrick, please go ahead.
Good afternoon, and thank you for joining us on today's conference call to discuss ChargePoint's first quarter fiscal 2025 earnings results. This call is being webcast and can be accessed on the Investors section of our website at investors.chargepoint.com. With me on today's call are Rick Wilmer, our Chief Executive Officer, and Mansi Khetani, our Interim Chief Financial Officer. This afternoon, we issued our press release announcing results for the quarter ended April 30th, 2024, which can also be found on our website. We'd like to remind you that during the conference call, management will be making forward-looking statements, including our outlook for our second quarter of fiscal 2025. These forward-looking statements involve risks and uncertainties, many of which are beyond our control and could cause actual results to differ materially from our expectations. These forward-looking statements apply as of today, and we undertake no obligation to update these statements after the call. For a more detailed description of certain factors that could cause actual results to differ, please refer to our Form 10-K filed with the SEC on April 1st, 2024, and our earnings release posted today on our website and filed with the SEC on Form 8-K. Also, please note that we use certain non-GAAP financial measures on this call, which we reconcile to GAAP in our earnings release and for certain historical periods in the investor presentation posted on the investors section of our website. And finally, we'll be posting the transcript of this call to our investor relations website under the quarterly results section. And with that, I'll turn it over to Rick.
Good afternoon, everyone, and thank you for taking the time to learn more about ChargePoint's first quarter fiscal 2025 results. Today, we are going to recap the first quarter's financials, some recent highlights, and discuss the state of the market. We will update you on our 4 areas of strategic focus, key accomplishments, and new partnerships we have formed. Our Interim CFO, Mansi Khetani, will give Q2 guidance in her portion of the call. I want to start by emphasizing that when we say we will do something, we fully intend to do it. My approach as CEO is to lead by example through clarity and accountability, provide regular updates, and drive the organization to deliver on our commitments, not our intentions. That said, here are the top-line financial results for the first quarter. In Q1, we delivered what we targeted in our last earnings call. ChargePoint's revenue for the first quarter was $107 million, which is above the midpoint of our guidance range. Non-GAAP gross margin was up to 24%, and I am pleased that our non-GAAP operating expenses came in at $66 million, which is down $8.4 million from last quarter and a proof point of the financial prudence I discussed in the last earnings call. Our cash management is a priority, and for the second quarter in a row, we used significantly less cash than forecasted. Our non-GAAP adjusted EBITDA loss for the quarter was down to $36 million, which is ahead of plan. While these results were positive, they could have been better. There were 2 areas where we saw opportunity. First, we had 8 figures worth of deals postponed to later quarters, primarily because of construction and infrastructure delays. Second, our inventory was up 13% as we stand behind our valuable manufacturing partners and continue to support our commitments. We chose to take the inventory and be a reliable partner over working down the inventory balance. Our inventory continues to gradually normalize, which we expect will take the rest of the year. Regarding our goal of becoming adjusted EBITDA positive in Q4, as I said at the beginning of this call, we will drive the organization to deliver on this and our other goals. We have a clear plan to get there, and we exceeded our internal goal for Q1 EBITDA. Some key drivers are as follows. Large deals that have been booked and will ship later this year. The deals will be announced by our customers at the time they find best for their respective businesses. There are multiple initiatives underway that will have a positive impact on COGS, OPEX, and margin-rich top-line contribution. These initiatives are specific and actionable and are embedded in our quarterly objectives. I will touch upon some of them in this call. As demonstrated in Q1, we will continue to reduce OPEX through operational rigor. We know you rely heavily on our past performance as an indicator of our future results. But I must remind you that we are a new leadership team with a new strategy and a serious commitment to operational excellence. As our Q1 results demonstrate, we are implementing positive changes that could not have been extrapolated based on our past results. Moving to the state of the market, it may feel like there is a lot to discuss this quarter, and there has been a lot of media coverage in the sector, but the story remains the same. EVs are selling, and people need the infrastructure to charge them. Various factors cause micro movements within this macro trend line, but the trend line continues upward. According to Bloomberg, non-Tesla EV sales were up 13% compared to the first quarter of last year. In fact, EV sales at 6 of the 10 best-selling OEMs increased 50% or more in Q1. As a reminder, while some OEMs are reducing projections for EV sales volumes, R&D continues at major global OEMs, including Honda's recent announcement to spend $65 billion electrifying their lineup over the next 10 years. Per a report from the International Energy Agency titled Global EV Outlook 2024, From 2022 to 2023, investment announcements in EV and battery manufacturing totaled almost $500 billion, of which 40% has been committed. Finally, to give commentary about plug-in hybrids scaling faster than pure EVs, we view this as beneficial for ChargePoint. A plug-in hybrid is a natural stepping stone towards full EV, and plug-in hybrids require charging. Plug-in hybrid buyers are prospective home charger buyers, and their adoption is putting utilization pressure on commercial and public chargers. We delivered nearly 4 million PHEV charging sessions at workplaces in 2023. If it has a plug, it is supporting our business. The bulk of what customers and investors are reading summarizes the demand curve for electric vehicles, not demand for chargers. Against Q1's micro movements on the macro trend line, utilization pressure on the ChargePoint network, which we believe is a key indicator of charger demand, not vehicle demand, has never been higher. In Q1, we saw commercial utilization outpace new charger installation by more than 20%. This has been building several quarters in a row, which indicates the need for incremental infrastructure to follow. To communicate this pressure in terms of vehicle adoption, in 2016, there were 7 electric cars for each public charging point. Today, there are more than 20 EVs per public charging point. A new trend we are keeping an eye on is quite intriguing. Growing site host sentiment that EV adoption has reached critical mass, and they are putting in charging regardless of current or future EV sales pace. In other words, we believe the correlation between passenger EV sales and charger demand is disconnecting. We will continue to monitor this with interest. What has moved from a trend to the norm is hardware and software disaggregation among our largest existing and prospective customers. It is becoming clear that the industry's leaders will supply world-class software to support an entire hardware plus software solution, regardless of who supplies the hardware. In North America and Europe, we see continued government support for infrastructure build-out. Starting with the U.S. National Electric Vehicle Infrastructure Program, results are going well for ChargePoint. As of today, and inclusive of the proposed awards in California announced earlier this week, ChargePoint's customers have been successful in winning more than 120 individual NEVI site awards, totaling roughly $71 million in grant opportunities. As the enabler of EV charging for entities who deploy NEVI funding, we support NEVI grant applications but aren't necessarily named as the awardee by the state agency. To date, about 30 state DOTs have issued competitive NEVI RFPs, and around 20 states have announced awards. We continue to support our customers in pursuit of NEVI grants that haven't opened their programs yet, as well as those that are on their second or third round of funding. In the EU, AFIR, the government's alternative fuel infrastructure regulation, went into effect on April 13th. While not an incentive program, AFIR sets targets for EV charging deployment and will encourage wider EV adoption. It will do so by setting standard requirements for charger hardware and software functions across the entire European Union. Not only was ChargePoint prepared to ensure our chargers are AFIR compliant, we helped establish some of the parameters directly with the European Union. Next, I would like to give you an update on our strategic priorities. As a reminder, last quarter I introduced our new corporate strategy to you, which is summarized by the 4 cornerstones of prioritizing our open modular software platform, revamping our approach to hardware development, delivering world-class driver experience, and operational excellence. For each cornerstone, I will now relay the demonstrable progress I promised last quarter. In terms of software, it has been a busy quarter. We announced the latest enhancements to our fleet software platform, which include home charging reimbursement for company car drivers, commonly referred to as take-home fleets, transit vehicle preconditioning and a substantially enhanced UI that is currently in its pilot phase. Most importantly, we made great progress opening our software up to third-party hardware in the USA. We had a good head start on this thanks to our existing work in Europe. ChargePoint's Be Energized software, which we sell in Europe to manage entire charging networks, has provided industry-leading experience in managing mixed hardware. Look for our first hardware OEM announcement in the coming weeks. In Q4 of fiscal 2024, we received FedRAMP certification of our software, which, as mentioned in our last earnings call, enable us to sell to the U.S. federal government. I am pleased to say that this certification is paying off. We booked 7 figures of FedRAMP required revenue in our very first quarter, including a sizable deal with the U.S. Navy. Our new approach to the design and manufacturing of hardware is also making a difference. Last quarter, we announced our partnership with Akbel Polytech Incorporated for future hardware, and in the first quarter, we began actively working on our first project together. As a reminder, this relationship will bring our products to market faster and at higher margins. We continue to develop this strategy, and today I am delighted to announce a second hardware co-development partnership. We have signed an agreement with Wistron NewWeb, commonly known as WNC, to work on a set of future hardware projects, and we look forward to a great working relationship with them. To recap our latest hardware news, we showed our upcoming megawatt charging system at the recent ACT Fleet Exposition. Designed for trucking, marine, and aviation applications, this is the most powerful charger we will offer, capable of 1.2 megawatts at launch and multi-megawatt charging in the medium-term future. To give an idea of how incredibly powerful this system is, our launch spec system can power more than 1,000 residential homes through a single connector. This upcoming connector protocol eliminates a key barrier to the electrification of large-scale trucking, which in turn has the potential to reduce or eliminate the 400+ million metric tons of greenhouse gases emitted by that segment. As we have said before, what is good for our business is also good for the environment. Our strategic decision to focus on a world-class driver experience has delivered a wonderful solution for our newest partnership. We have established a relationship with Airbnb to increase the availability of EV charging at Airbnb listings across the USA. To accomplish this, we created a novel solution for Airbnb hosts encompassing the ChargePoint HomeFlex residential charger, installation, software, and support services. For drivers, this will guarantee a charge where they are staying, a critical need for EV drivers on a road trip, and one not always accomplished at a hotel. Better yet, the world-class experience extends to the Airbnb hosts. We make their adoption of charging as an amenity near seamless. Once they answer 3 simple questions on our website, they have a quote including installation costs, and we can implement charging in as little as 2 weeks as a turnkey solution. We are now exploring compelling use cases for this offering outside of the vacation rental industry, which is important for me to call out as one of those actionable margin-rich initiatives currently underway. Operational excellence is our 4th cornerstone, and the area in which our results have surpassed our internal expectations. We had a good quarter and are ahead of our plans for cash, gross margin, OpEx, and adjusted EBITDA as a result. We remain disciplined, factoring OpEx and margin impact into every decision we make. This requires a lot of restraint, but has enabled focus and delivered results. The proof points above outline progress and deliverables under these 4 cornerstones of our strategy, which we will continue to do as the year progresses. Moving on to our latest non-financial metrics of note, this is another area of the business which continually demonstrates scale. In the quarter, we reached 2 amazing milestones. Most significantly, ChargePoint now offers drivers access to more than 1 million places to charge worldwide across public, private, and roaming ports. For us, this is a celebratory milestone. and equally impressive was the fact that this statistic grew approximately 10% in a single quarter. The other milestone reached in Q1 is that we have now enabled more than 10 billion electric miles for our drivers, which is approximately 3.5 million cross-country trips from San Francisco to New York. Our managed port count has grown to more than 306,000. Of note, the number of DC fast charger ports under management grew more than 14% in Q1 alone, for a total surpassing 27,000 fast chargers under management at the end of Q1. These statistics should leave you with this key takeaway. EV adoption is continuing at an incremental pace, and our network is scaling along with it. As our network grows, so do our subscription revenues. I'd like to thank you again for joining us today. To summarize, Q1, the results were positive, and we will gain momentum as the year moves on. If you look at our news and announcements so far in Q2, you will see that momentum is clearly building. Before turning the call over to our CFO, Mansi, for the financial review, I would like to once again remind you that when we say we will do something, we fully intend to do it. Hopefully you agree that Q1 was an early proof point of this. Thank you for your time and ongoing support.
Thanks, Rick. As a reminder, please see our earnings release where we reconcile our non-GAAP results to GAAP. Our principal exclusions are stock-based compensation, amortization of intangible assets, and certain costs related to restructuring and litigation. We continue to report revenue along three lines: network charging systems, subscriptions, and other. Network charging systems represents our connected hardware. Subscriptions include our cloud services connecting that hardware, our assured warranties, and our ChargePoint as a service offering, where we bundle our full stack solutions into recurring subscriptions. Other consists of professional services and certain non-material revenue streams. Moving on to the results for the quarter, revenue was $107 million, above the midpoint of our guidance range of $100 to $110 million. This was 8% lower than the fourth quarter, reflecting the expected seasonal slowdown, and 18% lower year-on-year due to lower hardware revenue. Network charging systems at $65 million accounted for 61% of first quarter revenue. This was down 12% sequentially due to the impact of seasonality and down 34% year-on-year in line with our expectations. Subscription revenue at $33 million was 31% of total revenue, essentially flat sequentially and up 27% year-on-year. Other revenue at $8 million was 8% of total revenue, flat sequentially and up 54% year-on-year. Turning to verticals, we report verticals from a billings perspective, which approximates the revenue split. First quarter billings percentages were commercial 63%, fleet 20%, residential 15%, and other 3%, generally consistent with last quarter. As Rick mentioned, we continue to see projects pushed out in both commercial and fleet verticals as customers await site readiness and vehicle delivery. Our home product continued to sell very well, and in the first quarter, a significant portion of our home units shipped were equipped with a NACS connector. From a geographic perspective, North America made up 81% of first quarter revenue, and Europe was at 19%. In the US, we generated our first sales from the NEVI program. Turning to gross margin, non-GAAP gross margin for the first quarter was 24%, up sequentially from 22% in Q4. Gross margin was down 1 percentage point year-on-year. The sequential improvement was largely due to improved subscription margins, as well as a larger mix of subscription revenue within overall revenue, which is typical in a seasonally low Q1 with lower hardware sales. Non-GAAP operating expenses for Q1 were $66 million, a decrease of 22% from $85 million in Q1 last year, and a decrease of 11% from $75 million in Q4, reflecting the full quarter impact of the January restructuring and our continued focus on cost management. Non-GAAP adjusted EBITDA loss for the first quarter was $36 million, a significant improvement as compared to a loss of $45 million in the fourth quarter and a loss of $49 million in the first quarter of last year. This improvement was achieved even with a lower revenue base due to gross margin improvement and reduction in operating expenses. Stock-based compensation in the first quarter was $22 million, down from $25 million in the fourth quarter and down $2 million year-on-year due to recent restructuring events. Looking at cash and cash equivalents, we ended the quarter with $292 million, down from $358 million last quarter. In addition to cash usage to cover adjusted EBITDA loss, cash consumption included a semi-annual interest payment on our convertible bond, as well as severance charges associated with our January restructuring. I am pleased to relay that the $30 million of restricted cash as of April 30th, 2024, is now unrestricted. This leaves only $400,000 restricted of our $292 million cash balance. As Rick mentioned, inventory balance increased in the quarter as we started to bring up our Southeast Asia-based partner. However, our inventory is primarily made up of finished goods and products that we are actively selling. We expect to bring this down in the second half of the year as we sell through the finished goods on hand. Our deferred revenue continues to grow. This represents payments for future revenue commitments from existing customers and finished the quarter at $235 million, up from $231 million at the end of Q4. Our $150 million revolving credit facility remains undrawn, and we have no debt maturities until 2028. We did not issue any shares via the ATM during the quarter. At the end of the first quarter, we had approximately 425 million shares outstanding. Turning to guidance, for the second quarter of fiscal 2025, we expect revenue to be between $108 to $118 million, down 25% year-on-year at the midpoint. As mentioned in the last call, we expect a larger portion of full-year revenue to be generated in the second half. This is due to the following: normal seasonality of transactional business, visibility into large orders booked across both commercial and fleet verticals for the second half, as well as signs of overall charging demand recovery driven by factors Rick alluded to earlier. We continue to expect gradual improvement in gross margin as the year progresses as a result of continued cost-down efforts for hardware products and improvements in subscription margins due to operating efficiency of the support organization, combined with automation initiatives underway. We expect non-GAAP operating expenses to remain relatively flat in the second quarter, but fall further in the second half of the year as we continue to focus on operational efficiency and other cost avoidance measures. We are committed to being adjusted EBITDA positive in the fourth quarter of this year and plan to achieve that through a combination of accelerated top-line growth, gross margin improvements, as well as operating expense reductions as we progress through the year. We are well capitalized to achieve this goal. In summary, we are pleased with the improvement in our overall financial performance, especially the improvement in adjusted EBITDA loss resulting from improved gross margin and reduced OpEx, as well as overall cash management. And we will continue to focus on these metrics as the year progresses. With that, I will turn the call back to the operator for questions.
Thank you. If you would like to ask a question, please press star one on your telephone keypad to raise your hand and join the queue. If you would like to withdraw that question, again, press star one. And please limit yourself to one question and one follow-up. Your first question comes from the line of James West with Evercore ISI. Please go ahead.
Hey, good afternoon, Rick and Mansi.
Hi, James.
Hello.
Rick, maybe first question for me on the significant number of NEVI wins that you've had so far, which should turn into grants and sales here. What's the expected timeline for recognizing those sales? I know there's been some delays in kind of getting the NEVI program underway, which I recognize we kind of all expected in the beginning as it's a government program and it had to go to the states. But how are you thinking about the rollout and the sales hitting your revenue?
We'll see some this year for sure, but we expect the bulk of it to be next year.
Okay, got it. And then you announced the new, or at least a new agreement, a joint development agreement with WNC in your prepared remarks. I know we had the Kimpo Polytech announcement recently as well. Could you maybe unpack kind of what you're doing there, what the strategy is, how you're realigning your hardware development?
Yeah, we have a very robust hardware roadmap and a variety of new products that we're very excited to bring to market. And adding more hardware development bandwidth to the overall effort is clearly beneficial to what we're trying to accomplish. So we've added WNC as a second partner in addition to Akbel Polytech to increase that bandwidth. And we have them each focused on certain areas of specialization that will allow us to bring some really exciting and compelling products to market as we move into the future.
Got it. Thanks, Rick.
Your next question comes from the line of Colin Rusch with Oppenheimer. Please go ahead.
Thanks so much, guys. If you look at some of these utilization rates moving higher and the pressure that's building around the overall network, can you talk about what you're seeing as precursors to incremental orders or incremental capacity build out with your customers in particular geographies?
Yeah, hi, Colin. I think in addition to the increasing utilization pressure, as I mentioned in the prepared remarks, we're also seeing this dislocation, especially in commercial charging, between the sale of EVs and the demand for chargers. I think in areas where there's reasonable EV penetration, you're seeing institutions that want people to come to their building putting in chargers now because they know there's a critical mass of EV drivers out there that they need to attract to their business or their institution. So you've got the utilization pressure going up. You've got this recognition that if I don't have EV chargers in my parking lot, some people I care about aren't going to come to my business. Combined is what's starting to show some demand in the commercial market for chargers that may not directly correlate with EV sales.
That's super helpful. And then, thinking about inventory levels and, what you've just added to the inventory, how should we be thinking about, kind of overall run rate on what you're going to be carrying and what this incremental inventory build, what is constituted in there? Is it finished goods? How much is components? How flexible is that inventory? And now should we see that trend through the balance of the year?
Yeah, hi, Colin. So it's mostly finished goods in the inventory right now. There's a little bit of raw material. There's some material in transit, but majority is finished goods. And it is made up of products that we're actively selling, all next-gen products. We review inventory very, very religiously every quarter. And it's all live inventory, actively selling products in there right now.
Okay, I'll follow up on that offline. Thanks so much, guys.
Your next question comes from the line of Bill Peterson with JP Morgan. Please go ahead.
Yeah, hi. Good afternoon. Thanks for taking the questions. I'm wondering if you've received any incremental inbounds or demand from customers interested in tapping your fast product. Pardon me, I'm at an airport. So Tesla Superchargers business uncertainty, obviously a big chunk of their team was let go. Have you seen any increased demand from, let's say, NEVI or commercial programs in particular?
Yeah, again, the Tesla changes, exactly what happened there. Some of it, has been reported on extensively, but I'm not sure how accurate it all is. So some of it's speculation, but from our perspective, there's been some clear benefit as a result of those changes. We've had access to some good talent that has become available, which is good for us. And we've also seen some changes in the market in demand in certain areas, apparently as a result of the Tesla changes, and we're absolutely, capitalizing on those when they come up.
Great, thanks for that. And obviously, you're expanding your hardware agreements across the board. I'm wondering how would you characterize any sort of obsolescence risk with your existing inventory? I mean, are you seeing any signs that customers would prefer to wait for any newer hardware from your partners in Asia? Or, I mean, are you offering attractive pricing? Like, how are you, planning to get rid of the high-cost inventory in your existing sort of product lines ahead of the newer products?
So I didn't catch the entire question clearly, Bill, but I'll do my best based on what I understood. So the level of inventory we have is something we will continue to work down as we move through the course of the year. We've got a lot of focus, as we've mentioned multiple times, not only in this call, but in prior calls around operational excellence. And one area of focus really is around managing inventory, as Mansi mentioned. So we've got, again, I think a very strong process in place now, such that we don't drive excess inventory. What we're working through is inventory that we have on hand, plus inventory we've committed to take from our valuable manufacturing partners. And we expect it to take the rest of the year to work through that and get down to what we would consider a normalized inventory in both on our balance sheet as well as with our manufacturing partners.
Okay, thanks. So I'll take the rest offline. Thank you.
Your next question comes from the line of Matt Summerville with D.A. Davidson. Please go ahead.
Thanks. To that last point, the fact that this inventory normalization you're looking at is going to take the better part of this fiscal year, I would imagine there's some sort of margin penalty associated with that. So as I think about next year, under, quote, a more normalized, operational situation in that regard, how much of an uplift should you get from not having to kind of deal with these issues? And similarly, I'd like just maybe a little more color on how some of these new Asian manufacturing and development relationships are sort of bearing fruit for you guys, and when maybe we really start to see more concrete gross profit improvement.
Yeah, your first question was very insightful, Matt. Thanks for that. And I don't know if I would call it a penalty on gross margin, but it's just definitely we're deferring optimal gross margin or optimal product cost. We're working through inventory on some product lines that was built at higher cost basis than we would enjoy if we were building that inventory new today out of one of our Asian factories or even one of our existing factories, because we continue to drive costs down on the materials that go into our products in addition to the overall cost of manufacturing them. So we expect, again, that inventory to be worked through by the end of the year. And at that point, we'll realize all the benefits of the cost down efforts we've taken, both on the materials that go into our products as well as the costs related to manufacturing of those products. Specifically on our Asian manufacturing partners, both now Bell Polytech as well as WNC are in production for us. And the benefit not only is the cost structure of Southeast Asia, where they're both located in manufacturing for us, but almost more importantly is the localized supply chain we can now access in that part of the world. Southeast Asia has been building high technology products for almost 50 years now, and the local suppliers there are very capable of building high quality, highly reliable parts at very cost-effective prices. If you look at some of our manufacturing we've done up to now outside of Asia, many of the parts that go to those factories come from Asia. So not only do we have a richer way to access the Southeast Asian supply chain capabilities, but we're also going to reduce lead time and minimize logistics costs because the parts are going to be much closer to the factories.
And then, thank you for that. And then just as a follow-up, I think you mentioned in your prepared remarks you had, $10 million or more in revenue that basically pushed to the right due to, resource constraints, I'll call that. And I guess I'm wondering if that constraint issue, is that something that is more more acute in nature or more chronic? Is that something that's going to get worse before it gets better? If you can maybe just talk through that a little bit.
So it isn't resource constraints on behalf of ChargePoint, Matt. It's resource, I don't know if you characterize it as resource constraints, but it's construction delays and the delivery of other infrastructure equipment like transformers and switch gears to sites that are under construction. That's largely what we see causing deals to move out from quarter to quarter are delays with site readiness and site construction.
Got it. Thanks, sir.
Your next question comes from the line of Chris Pierce with Needham & Company. Please go ahead.
Hey, good afternoon. What's the right way to think about subscription revenue being flat quarter-over-quarter after the step up we saw in the fourth quarter?
Yes, the reason for that was in Q4, we had a small adjustment in Assure revenue, typical year-end adjustment, which did not reoccur in Q1. So if you normalize for that, you would have seen a gradual improvement in line with normal trends.
Okay, perfect. Thank you for that. And then just following up on the last question, you know, the 8 figures of deals, is the right assumption that they would have hit this quarter and you still hit the midpoint above the midpoint of your top line guidance? Or is that just a general comment and that they've slipped and, you know, they weren't necessarily in this quarter?
Oh, if they had hit this quarter, we would have been above range. But now
were they in the range? Were they in the original guidance though, or that's getting too deep in the weeds?
Yeah, so we basically see some kind of deal slippage every quarter, right? So we have a guidance methodology that takes into consideration all of that. So we kind of ensure that we hit the range. So, you know, we did build in some kind of padding for that.
Okay, perfect. And then just one to follow up on one last question. So the right way to think about it is Acbel and Wistron aren't building next generation products right now. They're helping you build existing products at lower cost, and that's why the inventory that you have is the inventory that you're able to sell through this year, in theory, without taking any sort of charges against it. That's the right way to think about it?
Yeah, generally speaking, they're building current generation products as we speak. We're also co-developing next-gen products with them, and in some cases, there's prototype builds underway now for those next-gen products with both partners.
Okay, thank you.
Your next question comes from the line of Mark Delaney with Goldman Sachs. Please go ahead.
Yes, good afternoon. Thanks for taking the questions. You mentioned you have some bigger programs you expect to ship for in the second half of this year. Can you give us a sense of how much revenue you expect these larger programs to amount to in terms of the pickup in revenue?
Yeah, generally, as we had mentioned in my prepared remarks, you know, this year we're going to see a much more normal seasonality like we've seen in the prior normal years with, you know, majority of our revenue coming in the second half. And even as we kind of start emerging from this macro-induced slowdown in the first half, we believe that the second half will be even seasonally stronger than past years. We have factored in, you know, we're confident of the seasonality coming in because of these large deals that we're seeing in our pipeline. In all the verticals that we have, right? And on the fleet side, we're seeing large FedRAMP deals pushed out from the first half into the second half. E-bus continues to be strong. USPS deals are in there. On the commercial, we're seeing some Navy-funded deals coming into the second half, and workplace is picking up. On the residential side, you know, our residential product is doing well. We just announced the Airbnb deal. That'll give us some push. So all of this is kind of in the pipeline for the second half. In addition, we have new products like the pantograph that we've announced that's launching in the second half. So we're seeing good amount of pipeline built up for that as well.
Very helpful color. Thanks for that, Mansi. And then my other question was on OpEx came down to $66 million on a non-GAAP basis this quarter. I think you said it could fall further, I believe, on a dollars basis in the second half of the year. So I was hoping to better understand where OpEx dollars could go to on an absolute basis in 2H. Thanks.
Yeah, we're not specifically guiding to OpEx in the second half, but I do expect that OpEx will come down. So from the Q1 levels of $66 million, I think Q2 will kind of stay flattish. as we have, some mandatory raises in some regions, et cetera. So that will kind of wash out the cost avoidance initiatives that we will have. But then in the second half, we have specific plans in mind. One being a reduction in NRE costs, non-recurring engineering costs, as we transition more and more engineering over to our Asia partners. And in addition to that, we have a lot of different ways planned. Generally, what we saw in Q1 was, we're seeing fiscal discipline across the entire company, and this is showing amazing results. So we overachieved our plan in Q1, and so we're really confident that we'll achieve what we have planned for the second half.
Thank you.
Your next question comes from the line of Steven Fox with Fox Advisors, LLC. Please go ahead.
Hi, good afternoon. Rick, I was wondering if you can go back over the rationale behind the deals being postponed. I think the question we're trying to get at is whether this is something that we should think of as an ongoing situation, even as your sales grow, because of where we are in sort of supply chains, worker availability, infrastructure, or whether you think it eases or gets worse. Any kind of color on how you approach sort of the construction backdrop relative to your backlog, and then I had a follow-up.
Yeah, good question, Stephen. I think as Mansi alluded to, we've got a buffer in place where we account for this every quarter, and we're not planning for it to go down. We are not aware of any reasons that would allow construction to accelerate or other infrastructure gear that these sites rely on to come down dramatically with their lead time. So we're holding our assumptions regarding deals that roll over from one quarter to the next fairly constant as we move through the year.
That's helpful commentary. And then just on the beat in the quarter, I mean, outside of the inventories that was already asked about, it seemed like you consistently outperformed across the metrics. I don't know is there some overarching theme you would attribute that to when you, given all the changes you made organizationally, et cetera, or is it just little, singles and doubles here and there? Thanks.
Easy to summarize it up under this big headline called operational excellence, which is very easy to say, but it's a lot of work to do that. And we've got 9 different areas that we focus on specifically. And essentially another way to talk about this is we have the right people talking about those 9 different topics at the right frequency, making sure that we're making all the right decisions and managing our resources extremely efficiently. And again, we're really impressed with the results that our team produced in the first quarter. And we know there's more opportunity left to be had. As Mansi alluded to, we expect to see that show up in the OpEx number as we move through into the second half of the year.
Great. That's helpful. Thank you.
Your next question comes from the line of Chris Dendrinos with RBC Capital Markets. Please go ahead.
Yeah, good evening, and thank you. I guess maybe to kick off here, you highlighted some decent growth in the DC fast charger demand. I'm kind of curious, are you seeing any kind of pivot in what customers are demanding? Is there any changes in, I guess, level 2 versus that DC fast charger product?
No, I don't think we're seeing any demand changes between the AC and DC. I think what we're seeing is, new products like the pantograph that Mansi mentioned now in our portfolio, creating demand that wasn't there for us before on DC for the e-bus applications.
Got it. Okay. And then, I may hate to beat this one to death a little bit here, but just kind of going back to, the revenue cadence and some of the delays. And I guess, I think you mentioned, delays in product availability for, I guess, EV availability for customers and then site prep being ready on time. I guess what kind of gives you confidence that it's going to be there later this year in 2H? Do you have any, I guess, kind of firm visibility to, I guess, these sites being ready or the vehicles being delivered?
So again, on the commercial side, we're starting to see this dislocation between vehicle delivery and the desire for our commercial customers to continue to expand or put chargers in their parking lot. And We don't see any reason for that trend to discontinue. Another way to put it is, if you go to a local business in an area where there's reasonable EV penetration and not another EV was ever sold in that area, they would still make sure they had enough chargers in their parking lot to attract the audience of people in that area they care about, that they want to come to that building. So I think that's good news for us. On the other hand, I think you're seeing some really exciting product offerings either announced or coming this year on the passenger vehicle side. I've seen some really cool vehicles in our parking lot recently that have just come onto the market. So I'm optimistic about that. On the fleet vehicle side, I personally don't have any statistics on forecasted delivery for fleet vehicles, but anecdotally, for any of us that were at the ACT Expo in Las Vegas a couple of weeks ago, just the sheer breadth of selection and vehicles that are in production and available for fleets was very impressive. So it's based on that anecdotal observation, having personally been at ACT, I think it looks like that the fleet vehicles are coming.
Got it. Thank you.
Your next question comes from the line of Craig Irwin with Roth MKM. Please go ahead.
Good evening, and thanks for taking my questions. So, Rick, several times on this call, you've expressed confidence in the rebound in revenue, the rebound in outlook for the second half, and I commend the focus on achieving positive EBITDA before the end of the year. But when we look at your guidance for the July quarter, the second fiscal quarter, 108 to 118, at the midpoint, you're down 25% year over year, which is a deterioration from 18% contraction in the the April quarter. Can you maybe reconcile for us this modest deterioration as far as what you're giving us for an outlook versus what you expect to come together in the back end of the year? Is there a small piece that's maybe moving around on some of this political uncertainty, or some of the customers recalibrating with Tesla exiting the market? Any color there would be helpful.
Yeah, I can take that, Craig. So, in terms of guidance for Q2, we are being prudent in our guidance because the macro overhang still exists. In Q2, while we're seeing signs of the environment improving in our pipeline build, the RFP volume and RFP success rate internally within the business, this gives us confidence for the second half. But in Q2, we're still seeing some of the overhang, and so we're doing the right thing by being prudent in the guidance.
Okay, excellent. And then, my follow-up question is regarding fleet specifically. So, can you maybe give us color on whether or not utility work and site preparation is important and essential for you to recognize revenue if we see some of these very large fleet customers move forward with expanding installations towards the end of the year? A number of them have used ChargePoint in the past. Will this potentially be a gating factor for you?
I don't know if I'd consider it a gating factor. It is a factor that dictates the timing of deployment and therefore revenue. There's no question that fleet customers that are undergoing significant construction, try and time the delivery of the charging gear with the completion of the site construction work. So we are, our revenue and our shipping is dictated by that to a certain extent. So that's the way it is in this industry, and we work with that, and we make we build our forecasts on that factual information.
Thank you for that. Well, congratulations on the progress with the cost reductions.
Thanks, Craig.
That concludes our question and answer session. And with that does conclude today's conference call. Thank you for your participation, and you may now disconnect.
Hey, so hope you guys enjoyed that. I'm just going to close down their call so I don't have music in my ear. And then I'll just mention a couple things. Let's see. And that were kind of discussed in the chat. And really, that was just mentioned was just that ChargePoint's boring. It just goes up and down. And one thing that I feel like It's kind of like Wall Street's game is to, get a stock that retail's pretty excited about and, drive the price up so retail sees it, they FOMO in, they buy the top, and then, they, Wall Street or, whatever firms, market makers, hedge funds, whatever, they, let's see, I'll take a step back. Monthly chart, or maybe I'll just do weekly. They, drive price up, so retail gets really excited about it. A bunch of retail buys up here, hedge funds, whatever, offload their shares, short stock down, and then retail is just, all of these, it's like, this is not, this is a lower low, lower high. This is just, bear market, just bleeding. And it just discourages retail. It goes on for years. I feel like most retail probably has like a year time horizon. They, it's like, for me, like I don't, I try to be in and out of trades within a year. So I deal with capital gains tax. But I feel like, oh, well, I held for more than a year. I don't have to deal with capital gains tax. That's kind of nice. But I feel like, don't really want to be holding much longer than a year. And so this from like that top, this is a bleed of, this is like, that's 2020, almost 4 years, 1,239 days about. Retail gets bored. They get tired of losing, and then they sell at a pretty massive loss. And right now what we're seeing, I think, is we're discovering the bottom. I said here, this is on the weekly time frame, that, we're putting in lower lows, lower highs, and just bleeding coming down. And right now, what are we doing? We're doing the exact opposite of that. We're putting in higher lows and higher highs. And there's kind of this discussion going on that's mentioned in the chat that ChargePoint's boring, or, whatever stock is boring. I think I might just sell my shares and move to a different stock, different position. And, maybe something that's squeezing right now, maybe like Bitcoin miners, or maybe like shorting the stock market. I've gotten a lot of requests for that today. And so, why not pivot out of this ChargePoint because it's boring and into something else? And that's the game. That is what Wall Street does. They get people to FOMO in up here so they can offload their shares. Then they bore them over the course of multiple years of nonstop bleeding. And then this flat, more or less flat trading that we've seen, it's not necessarily flat because, from the highs here down to the lows, that's a drop of over 60%. But, if your average is way high up, this is effectively flat. And so it's just boring retail who have been holding the bag for years to get out of their positions. And then from that, we see price start to rally. And, I haven't noticed anything necessarily with ChargePoint related to AMC or GameStop or anything like that. But I feel like the market is starting to get exciting again for retail. And with that being said, we can look back to this big move. This was September of 2020. This one candle over the course of a week up between 37 to 38%. And then this big green candle up 58% over the course of that week was in November 2020. And the tops here, December, the end of the year 2020, and it's just bled. And so, it hasn't had, much of a similarity with AMC and GameStop, which started to move up towards the end of January of 2021, really squeezing up. And so, I don't see a similarity there. But what I do see is a stock that has been massively beaten down, and it's starting to show signs that it looks like the bottom could be in at 121. Price is not much higher than that. And so, I do view this purple uptrend as being notable resistance, but I view it as potentially being, I was viewing it as a neckline for a head and shoulders pattern here, which does look like it played out. And so from that, we get a measurement from the top of that head to the break of the neckline. Price went down more or less to that level. That represents coming down to 139 or 140. Price actually surpassed that measured move and broke to 121. But now, interestingly, what do I see with that purple line? Maybe it stands out to you guys, maybe it doesn't. What I see, I'm going to actually delete some of these lines that I put on during the earnings call, still more or less flat, down 2.3%. Basically, it opened today at 168. It's now trading around 169. So it's, nothing too exciting. And, I think it's kind of, bore retail out of their positions because nothing's happening. But what do you see? I just talked about this being a neckline for a head and shoulders pattern here. What do you see here? I see maybe this is a left shoulder, this is a head, and maybe we're at the peak, or I guess the valley of an inverse right shoulder. This was the armpit over here. This is the right shoulder that has not yet been formed, but maybe we do start to see a move to retest that line. And so, it's a little bit ugly, this right shoulder. I mean, it's gotten some, multiple touch points there. So maybe it's a little ugly, maybe that invalidates it, but what I see is a potential move to test that purple uptrend, whether it's an inverse head and shoulders pattern or whether it's just a trend line that's of potential significance from right around current price. That represents, let's say it takes us 3 weeks to get there. So that's what I have here as far as this box goes. That's about a 20% move to the upside. And so, yeah, I mean, from current price, from this boring price action, there's a potential 20% move to a level that might be notable resistance. But just like I did this measure move from this head down to the neckline here, I can do the exact same thing from this all-time low at 121 up to that neckline. That's a, let's see, a 70-cent move, 77-cent move. There's an ad coming up. I'm going to skip it. But after this explanation, I might throw up an ad and then I might close down the stream because I got to get on with some videos and I got to get to work later this evening. But so from this measure move up 77 cents, that would be taking that, moving it to the neckline, wherever we'd break it. So let's say it takes us 3 weeks to get up there, just enough time to bore people out of their positions. It's, taking its time moving up. I could, swing something else, FOMO into something else. That would put price at, let's say getting close to $3 a share. That's like almost $2.90. That could be testing this pivot point up here, right around 311. And then what do you see with that? I see another potential inverse head and shoulders pattern where, you could draw it different ways. I guess I would view it as, this being a left shoulder, this being a big head, and then that, connecting over here, wherever that high is, you could then draw a trend line. It doesn't even have to intersect with a peak here. It could just be going across here. As long as it intersects with the high here, that armpit, and then whatever this high would be over here, armpit, then maybe what we could see from that is a pullback to this purple downtrend or purple uptrend. Not very exciting. Retail, sees, price is going up to $3 a share. I'm going to FOMO in. And then what happens when we get to $3 a share? We actually bump into some resistance and we start to form that armpit, so that is the inflection point of this inverse head. And then we see a pullback to, it might be 225, something around there. I bought the top again. I'm never trading ChargePoint again because I always buy the top. And then that retail trader then gets discouraged after buying the top here, sells at the bottom at technical support, and then it takes off. And from there, let's see if that is to be the case. This is all hypothetical, borderline tinfoil hat, taking a measurement from approximately 121 up to around, let's see, that prior high. It doesn't even have to go that high. It could be slanted down. So let's say just up to $3 a share approximately. That represents 150% swing from the bottom. Of course, we're not at the bottom there, but that's $1.81 price movement. And so if we do get a move up to that level to form this head, and then we get a retracement to that neckline, I was saying around 125. So let's see, where's around a 125 intersection with that line? So that could be, right around here. That's a ways away. That's September. That's mid-September of this year. So that would be, we'd have to go through a break of this line. That's of course good from current price. Then a measured move up to here. That's great. But then FOMOing in at $3 a share, dealing with a pullback from that, and that potentially, bringing us back to a retest of this line. Maybe it's before September, who knows, and then going up from there. But then that would be bringing the stock price to $4 a share. And maybe that happens by the end of the year. Who knows? I don't know. But yeah, I think that right now we've hit the bottom at $1.21. We've been forming higher lows. And while it might be boring, but as long as we're not closing or getting wicks below the lows that were hit here on May 13th and 10th. So as the Friday, the low is $1.52, over here low 152. As long as we're not getting lows of $1.52, we're putting in higher lows and higher highs, which is the exact opposite of what we've been doing over the past few years, putting in lower lows, lower highs. And so, regardless of what happens following earnings, regardless of what happens in the next week, the next month, as long as the company doesn't go under, which is a possibility, as long as that doesn't happen, as long as they continue to expand, as long as there continues to be demand for EV charging stations, they're talking about their connections with Airbnb, and I've seen them in businesses where I live. We're going to be seeing more of them. And with that being said, we're closer to the all-time low than what seems to me like a feasible target of $4 a share by the end of the year. That's a more than 2x. And so if you want a 2x overnight, this is probably not for you. But if you want to invest in an EV charging company that's building infrastructure that, whether it's the US or the world needs, whether businesses or residences need, where municipalities need, and government needs. I think this is potentially a good long-term hold if it is to not go under, which is a possibility. But yeah, there are these gaps to the upside. It's boring. I add to my position all the time, which is larger than I probably would have liked it to be, but it's probably not really that big. It could be a lot bigger. And so I just casually add on dips, usually like one share at a time, which is super boring. But that's a nice way to get the average down. That's a nice way to keep me engaged because it's boring. But I'm retail and I'm still engaged. I'm not bored out of my position. And I'm not going to sell my shares at a loss because I'm bored. I'll add on dips. And it might not be super aggressive adding because it is boring. But yeah, I think that the chart looks to me like we got a lot of upside. So if you find it boring and you want to move to something else, that's fine. But I think that's common, typical, like retail mentality of buy the top, FOMO in at the top, and get bored at the bottom and sell it. And yeah, we're 50 cents away from the bottom, which you could argue getting back to that bottom is, a 30% drop. That's not really that bad considering what the stock has gone through. And it's maintaining above $1. Have there been reverse splits? I'd see them here. No. So, I feel like the company's managed its business pretty well, considering that it's a speculative EV charging station play and that it's near $1, but that it bounced. So it hit the low in April 22nd. It's been more than a month since then, and it's been forming higher lows. So yeah, I'm compelled to think that the bottom is in and that it's going to see $4 a share by the end of this year. But those are just my thoughts. And so I'm just going to check up on these comments because I went on kind of a ramble, and then I'm going to close this down. Yeah, and so as I read those comments, I'm just going to throw up an ad because I've skipped most of them, I believe. And so hopefully this is not annoying, but it is what it is. And so I'm just going to check on the comments. New subscriber, well, thank you. Welcome to the channel. It's, yeah, I mean, and to be honest, I'm a shareholder of ChargePoint. I don't get requests to cover it. And whenever I do, pretty much any EV charging station, they don't get many views. So I'm not really encouraged to do follow-ups on them. I used to do ChargePoint every week, but it just kind of faded, and my analysis kind of got boring because it was boring. But I get a lot of requests for Blink and also EVgo, and so I'll probably do charging station update videos covering those three stocks. I have done one on Beam, which is BEAM, but ticker symbol BEEM, and that's just not as, I feel like they kind of they're dabbling in other things, so I feel like they're maybe a little bit distracted. But yeah, I mean, infrastructure is something that, whether it's the US or the world, needs for like improving the electric grid. And part of that is charging stations. And unfortunately, like the government doesn't really do too much of that, or at least not as much. So a lot of that has been put on like the private sector, or, this is publicly traded. And so, yeah, I mean, I think that there's a lot of opportunity for that because it's like filling gaps that the government doesn't really fill well by itself. And maybe there's some government partnerships there. It does seem like they have some, they're involved in some programs that include like government stimulus. So, yeah, and so let's see. I'm just going to keep ChargePoint to $3. Yeah, I mean, I could see it. I think I don't have a super large position. And what I tend to do when I sell, when I'm holding the bag on something, I end up selling covered calls, ideally at strikes above my average. Sometimes that bites me in the ass. Sometimes it doesn't. With ChargePoint, let's see. I have, so it's not going to be, I mean, it's pretty cheap. I have 1,018 shares, which is probably not that crazy because it's, whatever. But my average, let's see, is $2.42. And so what I do is I sell covered calls at $2.50 strike, usually just make $1 doing that. So it's pretty pathetic. But it keeps me engaged as I hold over 1,000 shares. And then if I do that weekly, that's $10 every week. I can buy more shares selling those covered calls. And do I think that it's a sell at $2.50? No, but that's just a way to make a little bit of money on the bags I hold. So yeah, I mean, I think that this could be going up to $3, $4 by the end of this year. Yeah, fleet deals coming. I think that's exactly right. And that's one of the things that I've been like I feel like disheartened with about the USPS is I feel like they should be jumping on whether it's EV, like last mile delivery vehicles and EV charging stations, because the USPS is perfect for building up. Like that's like a win-win-win, I feel like, because you're putting money into small businesses, startups, I guess not necessarily small businesses, but to then sign contracts with them. So the EV companies are then mass producing delivery vehicles for the USPS. I think GOEV or Canoe is possibly going to be pretty involved in that. And then also Workhorse possibly too, but I think that they're larger vans, so maybe not. And then, Rivian is doing that, but with Amazon. And, at the sorting facilities or, post offices, they would then have their parking lots would be charging stations. And so, yeah, partnerships, whether that's, with any of these charging companies, I think if Blink gets a deal with the USPS, I think that's good for ChargePoint because, it's good to have competition and it's good that, while maybe a different company gets more market share in that sense, it's putting money on that kind of infrastructure being useful, that the USPS, the government, is investing in it. And yeah, and so I I feel like I was going on a ramble there, but yeah, I mean, I just think that EV charging stations, EVs, USPS, it's a no-brainer for me. But I don't think that the USPS has necessarily made the best decisions regarding that. But maybe that's changing as EVs become more accessible, more streamlined. I mean, like I said, I don't live in a huge city or anything, but I see Rivians where I live. And, I don't live too far from Chicago. I've seen Amazon Rivian vehicles delivering packages. So, I mean, with those charging fleets, with those EV fleets, they need charging stations. And so, yeah, I mean, I just think ChargePoint, all of them, I think it's great. And so holding strong, got 26,000 shares. Nice. Yeah, I mean, like for me, like ChargePoint is actually, I think, one of my larger positions. But right now, I'm really just kind of like, I guess technically my AMC position is a YOLO because I've invested more than 10,000 into it. But yeah, I mean, I feel like I'm just kind of focusing a lot on AMC right now. And, as that goes up, I might roll some of that into other positions like ChargePoint or whatever, getting my averages down. Or, I might just hold and, I'm experimenting with in the money calls. And yeah, I mean, let's see, I don't know, like I'd have to explore. I can do this right now. I'm going to look at some options, some calls for ChargePoint. With it being around $1, it doesn't really get too exciting because they're usually in like $1.50 increments. And so like this June, I think with in the money calls, it's better to do, this Friday, June 7th, not messing with that. That's just a couple days away, but doing like month-long contracts. And so let's see here. This is June 21st. If I gesture to that, it's because I'm pointing to my monitor where I can see the date. But you guys can't see that. But anyways, so June 21st. So like an in the money call is $1.50 strike. And then let's go the next month out, July 19th. An in the money strike is $1.50. And so for me, with my average, I forget what I said. Is it like 240? And, so I'm really just doing this as kind of like, 242. I'm just doing this as like a thought experiment for myself in trying to get a better understanding, a better, being able to better utilize options, not for, out of the money calls that I need to swing day in, day out, but ones that I want to hold to exercise. And so considering that my average is $2.42, that tells me I would be willing to buy 100 shares at $2 a share or less. And so with that being said, $1.50 strike, that is a premium of 41 cents. And so that's for July 19th. Or I could do June 21st. That's, not much cheaper, $38 for the contract. And so with that strike of $1.50, it's 100 shares, so it's $150. And, then this 38 premium or 41 premium, that would put it up to here, $1.91 or $1.88 would be the total, if I were to buy calls on this. And so I'm talking about this because I'm potentially interested in doing this myself. And so the way that I would explore that is I would first go over to, actually I got Max Payne up right here, but this is looking at AMC. So I go to this website, maximum-pain.com, and I'd look up ChargePoint's Max Payne for these monthly contract dates. And I'd actually, look on the weekly just to get an idea because sometimes there's a bias in the weeklies. And so look, $1.50 expiring this Friday. So, currently those calls are in the money because price is above $1.50. And let's go back up here. It's kind of, redundant. Now it's like the next week, $1.50. Going up to the monthly contracts that expire on June 21st, max pain is $1. So buying an in-the-money contract at $1.50 is kind of risky. If max pain is $1, that's saying that the market makers want to drive the price to $1. They want to drive it down, because then market makers make the most of money on options, whereas retail or whoever else is buying calls or puts, they lose the most amount of money. The maximum number of contracts expire worthless when it closes at the max pain. So this is the week following the monthly. This is $1.50. And then here, the week after that, let's see, $1.50 again. Really not too exciting, but I just want to go up on the weekly basis up to the expiration for monthly in July, which is July 19th, because I'm curious to maybe buy some calls. That's $2. So makes me think that June 21st is a little too soon, but with a max pain of $1 and price being well above $1, let's see, and max pain, we got to think about this. Also want to be paying attention to open interest. So open interest for June 21st expiration, we got maximum open interest, 59,000 at a strike of $1.50. So there's a lot of interest there. As we move into July, because it's, a couple months out, there's not as much interest. $2 is the maximum amount of open interest. And so that's saying that people, these are all calls, by the way, I'm not looking at puts here. The maximum amount of interest is, open positions are calls that expire at $2. And that's why we see max pain $2 for this day. But then interestingly, it's $1 for June. And so actually, I feel like if max pain for June 21st, and we're seeing this stuff with, GameStop, with this expiration in the money contracts. And so right now, if max pain is $1 a share, price is trading above $1. And so maybe buying, because this is like, if you buy a contract with a $1 expiration or $1 strike with an expiration of June 21st, and the premium for that is 91 cents, which translates to $91 because it's 100 shares, 100 times 91 cents. So that would be like, buying 100 shares at a price of $1.91. That's kind of how you get that, because you pay the premium of 91 cents times 100, $91 premium. And then you could then exercise your call at $1 if it expires in the money. But considering max pain is $1 for this expiration, considering price is notably higher than that, and all other expirations are either $1.50 or, like on July 19th, $2, we see maximum open interest at $1.50. I feel like the safe bet here is actually $1 strike, and 91. I don't know why I said that. To buy $80. So that'd be $1.80. So, I just convinced myself that $1 strike for June 21st expiration is an interesting buy, because the maximum amount of open interest, almost 60,000, is at a strike higher than that. Maximum pain is that, and price is well above it. That's an in-the-money call. So I find that pretty compelling. I don't know if this is boring, me rambling about options, but in all honesty, I haven't been too aggressive this week because I get paid on Friday, and I'll be able to utilize that next week. For me, I'm thinking about buying 100 shares of plugs. I bought a call option that might expire worthless, and I want to be able to have some exposure to that company. ChargePoint, I already do, but I want to get more involved in options, and then also buying more AMC. And so that's kind of what I want to do. ChargePoint call, plug shares, and AMC shares. So that's kind of what I'm thinking. But yeah, I'm going to check up these comments. And so fleet deals come in. I'm holding strong. Yep. Do you cover EV vehicles? I cover a lot of EV vehicles. So Those are actually pretty commonly requested. I've actually been wanting to do a Rivian video for a while, but I just don't have enough time and I don't get requested for them. Dude, Trey, I was just rambling on about options. So if you didn't listen to that, I think that things are going to be exploding June 21st because of what's going on, not because of Roaring Kitty. I think like you can think about Roaring Kitty in two ways. You can think of it as he's manipulating the market, or you can think of it as he understands the market and he recognizes what's going to happen and he's predicted it. That's what I see. I think that he's a pretty smart guy. And I think that with the number of shares that he has, that's going to cause not just GameStop, it's going to cause a lot of things to blow up. It's going to cause hedge funds to go bankrupt, and to have to shutter their doors, their windows, whatever. And so I think with ChargePoint having max pain of $1 for June 21st, I want to buy some ChargePoint calls because I already have a good amount of exposure to the company. And if it like through shares, and if that contract expires in the money, I can exercise it and get more shares, which would drive price up because I'd be exercising that, buying 100 shares. Or I could just, take profits on that call. So, swing it. So calls are like a really good way when you already have a position to kind of get more exposure, I'm finding. And so I'm just excited about them. And so as far as EVs go, let's see, I'm going to pull up this, I have this little calendar. These are videos that I do. I try to organize it. And so let's see, I did a video on Polestar yesterday. I'm kind of bearish on them. I feel like they might be the next one to go bankrupt. I'm streaming Neo tomorrow. I've been, if you check out the channel, I post some of the calls that I bought. I think I posted one on Neo, which does expire on the 21st. It's a $5 in the money call. I'd be happy to exercise it, but I'd also be happy to swing it. And then also, Neo over here. Let's see, other Polestar. And then last month, so this is for June, last month, switching over to May, I've done, let's see, other Polestar again. I guess I already showed that in the last slide. Let's see. Nikola is not really EV because they're more like, let's see, EVgo charging station. Workhorse, I need to do a follow-up on that because that was a pretty popular video. GeoEV or Canoe have done that a lot. But yeah, most of the ones that I do are penny stock EVs. But I'm really intrigued to do like Rivian. I really like Rivian a lot, but I just never cover it. And to be honest, I don't hold any shares. I did a Rivian Blink and Rivian video that was pretty popular, I think, or that was popular enough. But yeah, I mean, I'm happy to do EV videos. I did a Tesla video a little while ago. It wasn't very popular. But yeah, I mean, I think that retail is going to be doing really well by the end of June. And so I mean, if a YOLO is defined as $10,000, my paycheck's not $10,000, but I can't wait to get paid so I can put it all into my positions because I think that this month's going to be killer. And if not, it doesn't matter. I'm paying my bills, so I'm not doing anything that I'm going to wreck myself or anything reckless like that. So I'm in a fine position to YOLO my paycheck. But yeah, I'm stoked. ChargePoint calls, Neo calls, plug calls, which probably going to be expiring worthless, but whatever. AMC calls. Oh my gosh. Yeah. I mean, I just think that so much is going to explode. I think that this is a great time to be a retail investor. And I think that we're going to be taking some nice vacations by the end of summer. And so, yes, Saul says, live here in San Jose. And you can see ChargePoint stations everywhere. So yeah, I mean, I live in a small college town. I've seen ChargePoint charging stations here, which I never would have thought that. And so it's not boring. Yeah, but I like, the discussion of options. Cool. I'm glad you don't think it's boring. It's like everything is made to be more complicated. So it bores retail, or it makes retail think I am not, smart enough to understand it. But options, it's it's betting on the direction of a price, which is what you do when you buy and sell shares. But it's just doing it with an expiration date. And so I feel like that's a better way to have in and out plays, because I end up like, I've been stacking ChargePoint since here. I'm just going to open up on my phone so I see when I was buying. Let's see. I was buying, back in December. I like would swing some, but yeah, I mean, in November, October, I was buying back in October. It's probably, I was buying up here. And let's see. Started buying kind of aggressively not aggressively. I started buying on September 26th. So there's this gap down, and like right here, this is when I started buying, when it was like $5 a share. $4.89, and I have just done dollar cost averaging of one share as it's come down, and now I have over 1,000 because I got more aggressive. I think around this earnings, there was this gap down, and it's like, well, I'm just going to get more aggressive here and buy more, and I did that, and I've been holding the bag for a while, but I think that with calls, whether exercising them or just swinging them, I think that there are plenty of winning trades with ChargePoint right now. I think it could be up to $3 to $4 by the end of the year. And and Trey's saying, my mock SPY call this morning was profit over 200. I think a person could do well if they became fluent in charting and did SPY options. Yeah, and so for me, like, I haven't done SPY options because, like with ChargePoint, it's much cheaper. But then it's like, it's not going to swing $1, so then your profits are smaller. But like for me, but were you doing in the money options? Were you doing out of the money? I'll have to check the Discord. I've swung options that are out of the money and not doing them within a day, and then they end up expiring worthless, or I end up taking a small loss. And so like, looking at a chart and seeing like, oh, it's going to bounce, and then doing like calls like in that day. And I think, was it you that suggested, damn it, I need to, so next week I should do a stream for day trading. I'm off Monday, Tuesday, and Friday next week. And maybe streaming Monday would be actually, Monday might be rough because I'll be like transferring funds. And so Tuesday, I think I could maybe do like day trading, set aside some money and just like swing calls and or puts within that day, and just see. And like, if I lose the money, I'd set aside a certain amount, and that's what it is. So what Trey's looking for is, what I'm looking at is learning at this time, basically doing 0 days till expiration in the money calls. We could do Friday day trading stream next week if you'd want to do that. And we can do just like paper trading of calls. We could start at open and end, and I could like even have a spreadsheet up to kind of track stuff. So if you'd be interested in that, I'd be happy to do it, even if it's just you that's joining for it. But somebody on Twitter who's good to follow, I just posted his GameStop video, and he's like bashed GameStop for like the past years because it's just been bleeding, but now he's flipped because the chart's flipped. And that's Colin Gladman. He posts a lot of stuff about options, and actually he has like a Discord that is paid, but like, and spots fill up, but that's something that might be of interest, because he does a lot with options and coaching and stuff. But you can also learn that stuff. Like, you've already been learning a lot just posting stuff in the Discord and just like chatting like this. I'm not an expert, so I'm not going to charge you guys for this. But whereas, Colin, he has, a proven track record, and he posts losses as well as gains, and he's really good about it. He can also be a little brutal, which I think sometimes people can take offense to. But he's just being honest. Like, he doesn't want people to be losing money. So and need to do a paper for a while, track it to record percent win and go from there. So maybe if you want to do, or if you think it'd be cool, I could do like a paper trading options on Friday. Like, would that be for Friday or Thursday? Because I can't do Thursday next week. I mean, I could do it tomorrow if you want to do paper trading. I can't do it at open though because of Neo earnings, but I could do it right around then. If you want to do some paper trading via stream, and I can open up Discord as well. That could be fun. So yeah, I mean, let me know. We can pitch it to the Discord. I'd be open to do that tomorrow. I need to do a Bitcoin miners video though. And also I got to get a shorting the market video out, which I'll do. I have to go to work in a couple hours, so I got to get that out soon. And so let's see, I'm just catching up. You're correct. Today, Canada dropped rates 0.25%. That is why market ran today, in my opinion. Yeah, I'm not too keen on how, like, I know that rates affect price, and so that's why it rallied. You do it anytime is best for you. It sounds good. Yeah, I mean, for me, I might do some, like, I think it's a good idea doing paper trading. And so what I might do is next week, I might do a day trading thing where maybe I give myself $200, and other than that, paper trading, and I could track just for an entire day. Maybe next week, and I do like a workout side when I have my days off. So I'm just going to check the weather. Maybe there's nice weather all days that I'm off next week. Maybe I could do Tuesday or something. Do some paper and, swing positions that I would open and close that day. So that could be cool. Yeah, and maybe like look at charts Monday evening to kind of assess what would be good in and out plays for the following day. And so from what I understand, I'm reading this from Trey in the chat. From what I understand, with lower rates, it becomes cheaper for companies to borrow money. Now, how that goes on to affect the market, I haven't read that far. Yeah, so I think what it means is that like money's cheaper. And so because money's cheaper, that means it's like, I think like it's better to have money in the market than to have cash, I think. But I'm not really sure. Maybe I'm wrong about that. But yeah, eventually things will top. And so, yeah. And so on the note of talking about rates and talking about shorting the market, I should get to putting a video together on that. It will probably be unedited, but I will cover, so let's see. I'll just pull this up and then I'll end the stream. Got these indexes. So I'll probably, I focus most of my stuff on the SPX because that is, sometimes like the SPY, like when comparing with the prior all-time high, it got a little bit wonky. So I was looking at the SPX. So I'll probably go over the SPX, talking about the high and where I think it could be going, and then talk about how one can short that with either, SH, which is short that, or SPXU, which is leveraged short, I believe 3x leveraged. But then you can also do short the NASDAQ, which is SQQQ, or you could also do semiconductors, shorting semiconductors, which has been driving a lot of the market moving up. But, it's like, I'll probably just do it focused on these, and then I'll mention shorting semiconductors. But yeah, on that note, I'm going to close this stream down so I can get a video out before I go to work, and then I'll probably do Bitcoin miner video tomorrow. But yeah, thanks so much for hanging out. I hope you guys enjoyed the chat about options related to ChargePoint. I think that it's going to be a really exciting month for a lot of stocks that we're interested in. And since I didn't mention it when it was up before and it's popping up again, if you haven't already, make sure you like the stream, make sure you like the videos that you do enjoy, and always share your thoughts in the comments down below or in the live chat. Give me your requests. I'm happy to go over them either during live streams or I'll make videos on them, or, maybe I'll just post my thoughts. But yeah, that is it for the stream. Thank you so much for hanging out, and I'll see you bright and early for Neo's stream. I'll post a link to that. Their earnings call stream. I'll post a link to that later this evening. And yeah, I think it's probably pretty early. It might be at I think it's before the market opens. But yeah, I'll post that link a little bit later this evening.